Hi there, my name is Perry Sykes, and welcome to the Investor Resources Podcast. Today, it's May 12th. We're having a spectacular day on the market. So we thought it'd be a good day to talk about some potential market future paths that may be taken. As always, we do not make forecasts, but we do look at market data and try to come up with potential scenarios and see what our rules-based portfolio management strategy would do with those. So right now, as in most of the time, there really are three big things that could be happening on the market. S&P 500 in particular, we could take off into a bull market scenario from where we are. Everything could just stall, or we could head into a bear market. That's the case a lot of the time. Usually the indecision and the indecisiveness of the market is not as pronounced as it is right now. No one really knows where we're going to go right now. The bullish scenario assumes that the market's already bottomed. Indexes are going to grind higher. We're going to break through the 50 and the 200-day moving averages. The economic and monetary conditions are going to continue to improve. The stall scenario, which may be the most likely, predicts that we're going to have a lot of volatility, a lot of market consolidation, and periods of sharp rallies and pullbacks. That's going to reflect, trade tensions and slightly slower growth. And then we have the bear correction, deeper correction path, which would have to be triggered by some more severe economic downturns, some more geopolitical shocks, and some technical patterns that aren't going to be favorable to the market. So let's take a look at each one of those and see what the potential is for each one of those coming up right now. The bullish scenario, again, that means that we've already seen the lows for the cycle. The lows are in. We're going to wait till we get through the 50 and the 200-day moving averages, and after a brief period of consolidation, at that point, the market's going to break out higher. The death cross, which was so heavily advertised between two moving averages, would flip back to a golden cross, and new highs were going to follow. That's a possible scenario. It's going to require that trade agreements get in place. It's going to require that the Fed gets in line with what the markets and the administration certainly wants, which is an easier money policy. Those are required for that market, for a bull market to take off as we speak. So that's gonna take a lot of things to line up, all at the same time, and we're going to have significantly more trade agreements come down the path, especially with China. Today's market is mostly all about China coming out and saying, "Hey, right now, the conversation we're having, while there's nothing finished, nothing signed, it's very everything's looking positive. Constructive discussions are happening." That's a very bullish sign, especially with China, especially this early on. It's saying that the damage caused by tariffs and the market pullback is nearing an end, and it means that more and more trade partners are going to be getting those the trade agreements signed on, and that less hawkish Fed is going to come to the rescue with some interest rate relief, and the Fed has claimed they're handcuffed due to the low unemployment number, and they really can't keep inflation under control if they start cutting rates. But at some point, being too scared of inflation is going to cost them again. And while tariffs can be temporarily inflationary, once they take off again, it's going to be more likely that the Fed's going to need to react with a little looser economic policy than they're looking at right now. So there is a definite opportunity here for a bull market to take off and not look back. We think scenario B of the ones we're looking at, kind of a stall out, may be the most likely. We're not sure, of course, but that may be the most likely. which means that the tariffs are going to go on for a little more extended period of time before we get some resolution. Um, the signed agreements may not be as economically friendly as we envisioned in scenario A, where everybody just signed up and kind of acquiesced to what we need. Um, to cut discussions with China are going to continue, but that doesn't mean we're done yet. The first announcement, this morning that China said everything is very constructive. That doesn't mean a deal is getting done. And China, with their typically long-term view of all factors, aren't really concerned about being in a hurry. Although by all indications, the sanctions are hurting in China. They are, like we've contended all along, China needs us way more than we need them, and they're beginning to see that. So as these go on, the tariff deals are going to get done. They've been coming slowly, and the administration's been reminding people that these trade agreements are thousands of pages long. It's quite an undertaking to get through just one. And they said they had over 70 countries lined up that are ready to go. And for large trading partners, especially adversarial trading partners, those are going to be difficult. So those are going to continue to come out. In the stall scenario, they're going to come out more slowly. There's going to be some more trade tiffs show up where countries are going to complain about the way they're going. But they're eventually going to get there. But that means we're going to have continued volatility, both like today when it's really volatile on the upside, which no one ever minds it very much. That's always welcome, that upside volatility. But we're going to get downside volatility too. So the roller coaster is going to be fully implemented as both good news and bad news continue to unfold, and the entire tariff function tends to get dragged out a little longer than we thought, which is, again, easily seen. And if other countries come out with new tariffs, again, that makes everything a little more volatile. The Fed can remain hawkish. They're going to say, we can't cut rates. Maybe we're looking at the fourth quarter, if at all. Maybe we're pushed into next year, and that can tighten up monetary policy, which in the bond market liquidity, and the amount of liquidity that the government is providing is already coming under view as being a negative for the market. If the longer those go on, the longer those can become issues in a scenario that the market begins not to trust where we're heading, and there's enough question about whether we're going to get done with the tariffs or not, and the ongoing economic weakness, and the lack of a dovish Fed policy, that everybody begins to pull back. That affects consumers. Consumer sentiment drops, which means consumers stop spending as much. They stop putting off larger purchases. Those are all real negative as far as the economy goes. And as far as the market goes going forward, companies find it very hard to make decisions about deploying capital. In that scenario, they begin to get very tentative. They stop saying, well, we need to invest in whatever our outlook was, whatever our plan was. We need to wait. We're really not sure where this is going. So we're going to have to slow down here and put everything on hold. And then that becomes just kind of a self-sustaining cycle, and everybody begins to slow down, and the economy stalls out, and then you're just waiting for something to happen. It's probably going to be resolved to the upside, but maybe not as soon as we thought. And the longer it draws out, the more likely that scenario plays out. So that's why it's most likely most likely there's going to be more hiccups than not, and so that may be where we're heading, but we can never say for sure, because there's always the bearish outlook. Given the S&P 500 is already down over 20% off its peak, the market's already priced in, to some degree, weaker earnings, slower growth, and prolonged tariff negotiations. For a more significant drop, we had looked for a 40% decline off the peak of the S&P 500. This scenario would probably also coincide with a recession or some sort of credit event in the economy. Um, and it would definitely entail the Fed being very slow to react to the liquidity issues. And the government is, of course, then at that point providing less fiscal support than normal during downturns. And at that point, corporations are going to find it very difficult to deploy new capital. They're really going to pull in. And that's when consumers are going to stop spending at all. Everybody's going to just hunker down and hope for this to pass, and that's going to lead almost immediately to a weaker economy, consumer sentiment continuing to head down, people spending less and less money. Our economy is still driven mostly by consumer spending. We need that money out there moving the economy around. And if it stops, that really puts the brakes on everything. Corporations have no option but to fall in line and slow down anything they were doing as far as deploying capital for growth, because it's likely to be much longer before anything is going to be profitable again. So the straight drop bear market from here is not we think not likely, just like the straight up bull market is not as likely. So we would, at this point, we're leaning toward scenario B, the middle scenario, the roller coaster periods of intense volatility, because just like today's showing, boy, the news comes out and everybody reacts quickly, and it's going to be like, well, everything's great. When the news comes out on the bad side, it's going to be just the opposite. Everything's going to tank, and it's going to be, well, everything's terrible. And neither one of those is going to be true. But the market's going to react that way in the short term. And there's really nothing you can do about it when the uncertainty level is so high, which we're definitely there right now. So it's really impossible to pick the path going forward. Right now, it's really important to try to keep unproductive behavior in the market at a minimum. You need to not trade on emotions. That's why it's so important right now to have a rules-based portfolio. You need to know what's going to trigger buy and sells in your portfolio before you're in volatile cycles that we're in right now. And if we're in kind of the stall mode and we're going to have a highly volatile consolidation coming up, which either way is probably pretty likely, your rules-based portfolio are going to be fully tested. You're going to need to have confidence in what you're doing. It's very important that you already have those in line. So if you're not there, get it in line as quickly as you can, because as I said before, there's no way to know which one of these is going to unfold. One of them is going to happen. And because it's impossible to predict, you need that rules-based portfolio strategy that's going to allow you to adapt to whatever unfolds. So you're not hanging on one or the other. And if everything goes great, you're going to do fine. If everything goes poorly, it's going to be a disaster. You don't ever want to be in that position. You need those rules-based adaptive portfolio strategy that's going to allow you to move with this market, because there's no way to tell where it's going to go. And as today has shown you, today's market, when it moves, it can move a lot. So if you found this important, please subscribe. If you'd like us to take a look at your portfolio, we would love to take a look at what's in it, apply our rules to what you own. We don't need to know how much money you have. We just need to know the holdings in your portfolio. Coming up on the screen, you're going to see our email address. Send that to us. Send us your portfolio. We'll be happy to run some our strategy on that. Let you know what we think your portfolio looks like as far as the strength going forward, and that's a freebie. We'd love to do that for you. We will be back shortly with more to come on what's going on in the market out there. Thanks for being with us today.